What do we see from the PBOC?
Yeah, the latest inflation outcome probably would mean that there is a little bit more room for some further monetary policy easing. However, in China, seems the PBOC continues to be quite targeted, focusing on liquidity measures only, with still very heavy bond supply and also the certificate of deposit maturing this month. We do believe that more liquidity injection is needed, and ideally some long-term liquidity injection rather than only through very short tenor OMOs. So we would still do not rule out a reserve rate cut, although actually market expectation is not too high for that.
So we have China's economy, doing pretty well coming in at the first in, first out. But at the same time, you've got this dollar weakness. Then you have tensions not only with the US, but also with Australia as well. You've got a pretty bold call for the CNY to get to 6.5 by the end of next year. What sort of level are you looking at in the more short term? And I guess, where do we see resistance here?
Right. Upon this reversal in the dollar bear trend, I think in the short term, we probably would enter a consolidation period for dollar CNY. So we would expect some range bound between 680 to 685. More appreciation room for the renminbi would be for next year. There we see basically one supportive factor, which is China's very robust external positions. And there were two parts to it. First, current account. Merchandise trade recovered earlier than services trade. And precisely, we know that China has goods surplus and services deficit. So that put China in a very favorable position when surplus widened but deficit narrowed. Of course, this dynamic can change maybe after a few months. However, there are also more sustainable flows, in particular bond inflows. There will be another review later this month for Chinese government bonds to be whether or not to be included into another index. But even if without this decision, with the previous inclusions into the Bloomberg bond index, we reckon that the corresponding passive bond flows have been lagging behind. So in other words, there may well be some catch-up to play. So would expect flow-wise that is quite supportive of the renminbi.
Frances, okay. The RMB is, of course, in your view, going to be strengthening as you're predicting. But how far is that a function of dollar weakness? And how far does dollar weakness actually persist? And the other part of my question there is, what's the impact for other currencies in this part of the world?
Yeah, we do believe that this dollar trend, the underlying one, is still bearish one, mainly because of the unfavorable yield differentials, with the Fed very dovish and with interest rates staying low for a yet even further extended period. In comparison, Asian central banks are arguably less dovish, and especially with the PBOC, which has been quite reluctant to deliver outright interest rate cuts. So from that perspective, would expect yield advantage to continue or at least maintain for a slightly longer period. But in the short term, definitely, especially between now and the U.S. elections, would expect market to become slightly more risk averse, bracing for some headline risk. That's precisely why we are expecting range bound in the coming weeks before another leg of appreciation in the renminbi kicked in.
And the impact for the rest of the region from a weaker dollar? Because normally a weaker dollar is actually very good for emerging markets.
Right, and we have a weak dollar. I mean, like not the recent trend, but as a medium-term trend, there is likely to be a weakening trend, and then it's just anything is just bilateral. So a lot of the Asian FX shall be supported, not to mention the yield differentials, which is likely to stay. And then I think there is a little bit of relative performance as well. Merchandise trade recovered first, so that might actually benefit the Northeast Asia bloc, the like of the Taiwan dollar, the Korean won, etc., before services trade such as tourism and education recover at a later stage. So we are seeing more confidence in the exporters, merchandise trade exporters. But in the short term, especially when risk aversion is heightened, the Taiwan dollar used to be fairly resilient.
Frances, what are you looking at in the bond market when we see such differentials in the yield space?
Now, we are looking at both nominal and real interest rate differentials. Nominal yield differentials are quite obvious, widening in China, in India, stay quite high for even the low yielder in the regions, which are Korea and Thailand. And for real yield differentials, which is actually a more medium-term consideration, and we have to take into account of the different credit ratings. So we compare the real yield differentials with their own history. And we still have a few markets in Asia which have their real yield differentials above their own multi-year averages, such as the rupiah, the Thai baht, the Korean won, and the Taiwan dollar markets. But of course, like FX volatility is one key consideration, such as in the case of the rupiah, that when there is heightened volatility, investors would like to increase their FX hedge, and the hedging costs, unfortunately, usually tend to be higher when the volatility is higher. So that is something that is kind of making foreign inflows from coming in even more aggressively.